Every day, financial markets move billions of dollars. Yet behind every tick up or down lies something simple, but powerful. It's not luck, nor magic, nor guesswork. If you've ever stared at a chart and wondered, why did price just move? You're in the right place. Trading is the act of buying or selling assets with the goal of benefiting from price changes. Unlike building a business or inventing a product, a trader operates by reacting to the market, not creating it. You might trade currencies like the euro and dollar, stocks from Apple to Tesla, market indices, or cryptocurrencies like Bitcoin. Each market has its quirks, but the underlying logic stays constant. Buy when you see an opportunity for price to rise. Sell when you expect it to fall. But don't be fooled. Trading isn't about bold predictions. It's about assessing probabilities and managing risks with discipline. Many believe that price moves randomly, but if that were true, genuine patterns and persistent trends wouldn't exist. In reality, price shifts for one reason: imbalance. The market is an ever-running auction of buyers and sellers. If buyers outweigh sellers, prices climb. If sellers dominate, prices drop. Only when both sides are matched does price stay steady. Imbalance is the fuel for movement. Price rises or falls whenever one side is more aggressive or resourceful. But not all market participants are equal. On one side, you have retail traders, people trading with small amounts, using charts and simple strategies. On the other, massive institutional players, banks, hedge funds, and others with capital that can shake markets. These big traders cannot simply buy or sell with a single click. Their orders are vast, and entering all at once would push the market against them. So, they wait for liquidity, pockets where enough orders exist to absorb their trades, often at places where many retail traders set stops or pending orders. Liquidity is the collection of buy and sell orders resting in the market, waiting to be activated. Stop losses and pending orders often cluster at obvious levels, creating pools of liquidity institutions seek out. Price is often drawn to these areas, not by chance, but by necessity. For large players, liquidity isn't optional. It's vital for entering or exiting without unwanted market shocks. Many traders fall into predictable traps, buying after a sudden jump, selling after a sharp drop, or piling into obvious support and resistance zones. What often happens next? The market pushes a little further, triggering those clustered stops, before reversing in the expected direction. It's not manipulation, it's the market's search for liquidity, driven by the logic of order flow, not randomness. As we move through this series, you'll discover where liquidity really hides, how the market traps traders, how to read market structure, and, just as importantly, when it's smart to wait. No hype, no magic, just clear market logic to help you think and trade like a pro. Remember, trading is a game of probabilities, not predictions. Price moves because buyers and sellers are rarely in perfect balance, and it's the actions of the biggest players, hunting for liquidity, that shape the market. In our next lesson, we'll dive deeper into the nature of liquidity and why price relentlessly seeks it. Welcome to an exciting trading series. I hope to see you in the next video.